My name is Abid Deb. I'm working as a functional consultant with Bisman Web. Today's discussion is inventory adjustment. What is inventory adjustment? So let me see in details. The more inventory a company has, the less likely they will have what they need. This means inventory adjustments are done because to make the stock available and the working capital for the company. So both has to be well balanced. So what do you mean by inventory adjustment? Effective inventory control is one of the most important ways your business can ensure the financial information you rely on for reporting, forecasting and audit purpose is complete, accurate and up to date. And one of the most critical parts of a successful inventory system is the use of inventory adjustment. The process itself is not terribly complicated, but ensuring it's done properly can save you from needless frustration and costly delays in today's data-driven business environment. So changes in inventory levels don't always come from sales. Sometimes it is necessary to modify inventory levels to reflect changes in your actual inventory count that might not be in your records. Inventory adjustment refers to adjustment entries made in a periodic accounting to account for differences between the recorded and actual inventory system. So that is the stock verification, physical stock verification. Now adjustment reasons vary. Positive inventory quantity adjustments are often due to the addition of more inventory from production or excess inventory that remains saleable but did not sell. On the other hand, negative inventory quantity adjustments are often required to address. So the stages has been set, which has been defined into 5 steps. So number 1, waste, expired or obsolete inventory, common in foods and consumer goods. Number 2, breakage, damaged inventory that cannot be legally sold as new. Number 3, shrinkage, inventory lost to theft, also called stock loss. Write-offs, inventory lost to other reasons. And lastly, the internal use, inventory items put to internal use or consumed by the company instead of being sold to the customer. So with manual inventory process, some of these changes may not be noticed, let alone recorded, until a scheduled inventory count is performed. The adjustments recorded during such a count include specific information for each affected item, such as unit cost, number of items, etc., and will be used to calculate the actual value of current inventory, so accounting can accurately calculate cost of goods sold. If your business uses the periodic method of accounting, also called the periodic system, your inventory counts record only the cost of the previous year's inventory and do not change. Instead, production and inventory related purchases made during the current accounting year are lodged in a temporary accounting used to make the necessary adjustments entries during the closing of accounts at the year end. So when your accounting item is finalized, your records for the current year, inventory adjustments are used to modify the beginning balance in the inventory account to reflect the cost of the ending inventory. So why inventory adjustment matters? So it's a big question. Inventory fluctuations can wreak havoc on more than just your stock room. When recorded inventory levels are lower than actual inventory counts, understand the cost of goods sold rises artificially. Conversely, when actual inventory levels are lower than recorded overstated, the inverse counts, the cost of is artificially lowered. In both the cases, the adjusting entries necessary to reflect the true state of affairs can have a significant impact on your gross and net profits, your income statements, and by extension, your company's competitive advantage, financial agility, and overall health. Decisions making, reporting, auditing, and budgeting can all be skewed to disastrous levels if your team is operating with incomplete or inaccurate information. So, this is all for today. Thank you very much.